First of all, I want to thank Sanjay for inviting me to this class. And I wasn't sure that I have anything to say that will interest anybody in this class. It's, after all, I think what you're learning is actually very interesting. It's a very interesting collection of ideas. And unique in that this style of investing is actually, this method and approach to investing with modes is being articulated and taught in India. I think that's actually quite interesting. If anything, I think at points in time, you step back, and I think I would encourage all of you to step back and reflect on what you have learned. Because investing is not just about following recipes and prescriptions, it is about learning from people who teach you. And so what I'm going to talk about today, really, it falls into two parts. First part is about my approach to value investing. I worked at Third Avenue. I've been in Third Avenue for some total of over 20 years. And I've been exposed to market for more than 20 years, really going back to 1984, when I started dealing with the predecessor from NGO company. So over the years, I've been blessed, privileged to deal with somebody who would learn from somebody who I think is an extraordinary investor, unusual investor. And again, one learns. And investing is actually, as you will see, a very personal kind of thing. And there's a whole number of things that you do that are very subjective in nature, and how you do them really reflects what you are in your background and so forth. So with that, let me get going here. So I'm known to talk too much. Let me do this. Play. First play. Is that play? Well, okay. No. No. Well, I'm entering helplessly in mail mode now. Okay, I'm just, that's it. Perfect. Okay, so let's get rolling here. So what I'm going to talk about is really divided into two parts. First, what I want to talk about is sort of articulate a framework of investing, the framework how I thought about investing, was sort of developed over the years, doing what we did at Third Avenue with Marty. And then my takes on how I approach it. And the second part of it, I'll talk about a class of companies that are very interesting, which most people don't think about, especially in India and many developing countries. So let's get started here. So here is my first item. So there's a lot of value investors out there. Everybody, of course, is looking to buy things cheaply. And I, like others, am looking to buy businesses and assets cheaply. Now, what exactly does cheaply mean? Because no one's going to tell you that they're out there to buy expensive stocks. Everybody's out there to buy cheap stocks. What different people define as cheapness really varies from person to person to person. So a whole part of the distinction between how people operate is how they get to what is cheap. Okay, so how people arrive at the notion of cheapness and how they really implement their investment approach. So this is, as I said, really a framework rather than a collection of prescriptions. It is rather more something that you use as a basis of thinking about investments rather than something you plug into a computer and out pops an answer. Okay, so this is to be viewed, you take this sort of stuff, mesh it with your sort of subjective judgment, your understanding, your background, your baggage, intellectual baggage, and presumably something will come up during the process. So, again, as I said, just to emphasize that this is a framework, it is not a prescription. It is rather something that, if you internalize it, you will probably have a roadmap to doing stuff. But two people with the same set of prescription, the same set of things, these sort of items, will wind up at potentially different paths. So anytime you see portfolio managers and have a portfolio using the same basic tools, they can run with two very different portfolios. Clearly, this process will result in a very different set of investments between different individual portfolio managers, between different firms who have slightly different investment philosophies, albeit they call themselves value investors, and even within, say, a Third Avenue, for example. Because different of us come with different baggages, background, knowledge, bases, and so forth. Okay? So let's talk about these things, 5 key points, which I think, if you take these 5 key points in conjunction, you will probably differentiate what it is over the years I've done, versus most other value investors. And there are implications to each of these things, which we'll touch upon in a minute. First, the first thing is, you are going to buy things based on the attractiveness of the individual business itself. Because the individual business is the key focus of your attention. So what you're going to do is it's a totally bottom-up investment style. It is not a style that is a result of making a macroeconomic forecast for the future, projecting things into the future, and then make your investment decision, be it by sector, be it by company, and so on and so forth. What you're going to do is you're going to focus upon the business itself, and which is why I call it, it's a bottom-up consideration, it's macro myopia. There are very few people who can actually forecast things macroeconomic again and again and again accurately. So now, if you're going to risk other people's money and your own money on that, aren't you going to try to risk it in stuff that you know with some degree of certainty, rather than make assumptions which have a reasonable probability of being false? So I call it thinking in terms of the business itself and in terms of assuming macro myopia. So how do we deal with the fact that things do not unfold in the future that you assume? Well, so when you look at business, when you look at a company, when you analyze a company, you'll think about how the company makes money and under certain scenarios, and start varying the scenarios. Start varying the macro scenarios with things that are adverse. Once you start, it's basically think of stress testing the company, the business, the profitability, the results, operational of the company, based upon any adverse changes in the macro environment. The company has to be a survivor. So what you want is something that's very robust under adverse developments. I mean, not outrageously adverse developments, but plausibly and reasonably severe adverse developments. For example, you can have businesses which have currency mismatches, for example. You have borrowings in one currency, revenues in another currency. You have asset liability mismatches. People often forget about those things. Those things have wiped out people again and again and again and again over the years. So the idea here is, after identification of things that are interesting, and we'll get to other elements, what causes identification, you stress test this with adverse movements in things macroeconomic. Because you don't make macroeconomic assumptions, each of your investments will probably be generated on a one-by-one basis, on a bottom-up basis. Similarly, analogously if you wish, if you are operating with macro myopia, what you will not have is a basis of making judgments about the future, things that are typically going to be, say, the real estate market is going to do wonderfully, therefore I will buy real estate. So you do not have sectoral bets being placed based upon macro assumptions. So a portfolio that emerges from something like this will be very, very different from anything that an index has in there. If anything, it is a very anti-index portfolio. Because indices, for example, and again, I'm speaking of this in reference to sort of a global investment approach, because historically that's what I've done. I've never been constrained to one country versus another. The portfolio results from this is going to look nothing like an index. Any index constituents that wind up in a portfolio of this are highly coincidental. I don't know typically in a portfolio of mine which companies are members of an index. Typically, it's usually very large cap companies that actually are part of an index, but by and large, there is no bearing on my decision. Okay? The second thing really is, you buy businesses at significant discount to conservatively estimated net asset value. Now, this is where the rubber really meets the road. What is conservatively estimated? One person's conservatism is another person's rashness. So, I'm known historically to be a very pessimistic person. Very pessimistic person, and that is typically conditioned the way I look at the world, look at investments in general. In fact, there was, as a sort of a satire, one of my colleagues had a collage of me standing there with a placard which said, "Things will get worse." That is the way I view the future. Well, the future, as I said, is unknown. Things may get worse, they probably will get worse, and you'll see why I say that in a minute. And how do you estimate a value that is robust under many different kinds of scenarios? Scenarios where things turn bad, So the way I've approached it historically is to think, okay, what is this business worth today? Suppose we shut down the doors today, sell up the pieces. What am I going to get for this business? Somebody else buys the pieces. And what would I, under reasonable valuations, get for a piece of the business such that I can sell it off to you? So I'm attaching no premium, very little premium, if any, no premium usually, to what the future may hold, because I don't know the future. And usually, the conservatism is expressed both in the asset side of the business and the liability side of the business. Let me first tackle the asset, then we tackle liability. So the assets, as I said, you'll think in terms of the business as being closing down its doors. What are the constituent parts of the business worth today? Okay, so not it's going to add so much value going into the future because of the characteristics it has. That's great, it's a bonus, but what is it worth today? The liability side gets more interesting. So typically, when people think of liabilities, you think of debt, stuff on the balance sheet, then there's stuff recognized off the balance sheet. It's like things that people have to spend, things, all the commitments, contingencies, all that stuff that turns up in your financial footnotes. So that's the other part. So typically on and off balance sheet lines. That's sort of general convention. So there's a third part to thinking about this. Now, I grew up in a business. I grew up for a number of years. I worked in a company. It was a horrible business. It was a horrible business. The business was pulp and paper. The pulp and paper where you had huge paper mills, very capital-intensive businesses, very cyclical. And the problem was these businesses, that this kind of business required reinvestment. And the sort of joke was, in the pulp and paper industry, you can either have a company with good assets or a good balance sheet. Rarely are you going to have both at the same time. Why? So you need to reinvest in the business. You probably don't have the money on your balance sheet, so you borrow, improve your assets. That's how debt winds up on your balance sheet, and you have good assets. Conversely, you just run these assets, pay down your debt, you have a great balance sheet, but your assets, which are going to need a lot of spending. So very often you find businesses that have underinvested over the years, and as a result of that, wind up understating the nature of the business liability. The liability which you require, which should be on the balance sheet, is not on the balance sheet, but is necessary for the company to continue in business. So somehow you have to recognize this liability when you value a business. Because one of the things that's going to come bite you on these days is that this is going to have to be done, and suddenly a liability pops up. And therefore diminishes the value of your business. So what I've historically done is you assess the liability, you learn about the business, you learn how much money is required to keep it going, and a legitimate general normal business. Not excessive amounts of business, not excessive amounts of spending, but what is needed to continue running the business. And you wind up with some sense of a recurrent business liability. Take that, capitalize it at some reasonable capitalization rate, and add it to the rest of your liabilities. So you will have three kinds of liabilities. One liability is liability that's on the balance sheet. Second is the off-balance sheet liability, which is disclosed, usually stuff they have projects that are going on with us, 25 million, 50 million, 100 million to do something, complete something. And then there's this other recurrent liability. You capitalize all these things. So that's how you get probably a better picture, a fuller picture of the liability space of the business. So on one hand, you have the assets, conservatively estimated. On the other hand, you have liabilities, estimated, again, trying to capture the economic reality of a business, deduct them, and you're going to get a very conservative net asset value. Now, a conservative net asset value, I would argue, is a great thing. Great thing because it takes a lot of bad stuff to happen to business to get the price down there. So when you buy a business that is trading below this kind of calculation of net asset value, the stock price has declined a lot, really a lot, in that it includes enormous amounts of pessimism built into it. And usually, it's not a bad time to think about if this meets the rest of the criteria, to start thinking about it. So conservatism really results in the washout of a lot of what I call the price risk in buying something. Okay, so That's one half of the story. That's a good half of the story. Now there's a bad half of the story. The problem is, this style of investing, this style of assessing value and acting on it is so conservative that if there is a whiff of optimism, you get priced out immediately. The price is well above a very conservative net asset value, and you wind up with a situation kind of like stuff if you're going to be a disciplined investor. And objectively, what we're trying to do is buy things below their net asset values. A net asset value, really, we're trying to get at, the number that we're trying to get at, is what would somebody in the business, in that industry, be willing to pay for this in a non-hype, non-distressed transaction, assuming a normal financing. Yep. So it's a cash transaction we're looking for. And ideally, you want to buy it with good signs discounted that. Hence, you go through all these sort of acrobatics to figure out what is a conservative net asset value. So that's stage sort of 2. I mean, this is one of the things you start to find cheap things that way. It takes a lot of look to do it. But if you think that's bad, that's already you're beginning to eliminate lots of interesting candidates. The third one is going to eliminate a lot of candidates. The third criterion is related to risk. There's a lot of things that are cheap out there. There's a lot more things than you think that are cheap out there. You just have to look for them. But many of them are probably not worth buying. Why? It is because of the risk that attaches to buying something. And the kind of risk that I'm talking about is not the risk of stock prices going up and down. That is of no interest to me. That really is a very, very limited interest in that what I'm buying are assets and or businesses. What I'm concerned about is there something that could happen to the business or asset that I'm buying that would damage the value of the business permanently. Don't think of this as the same thing as the stock price, because it is not. The stock price goes up and down every day, and it will continue to do so. That's something that coexists. What you're worried about is there something that will cause me to lose money on a permanent basis? If so, you should wait. Now let's just dwell upon this, because this is really one of the most important elements of this approach to investing. It is the matter of the safety of your capital that you are investing in the business. Now, first, we obviously talk about cheapness. That's a starting point. But a really tough filter to get something invested through is the risk. So where do these risks come from? So, as I noted, you avoid business and financial risk, but embrace market risk. Now, I'll get to the implications of embracing market risk in a moment, but let's talk about the sources of business and financial risk, the stuff you got to avoid. You want to avoid things that'll hurt your business, value of the business, stemming the result of factors that are internal to the company or external to the company. I'll just lay out a couple of generic factors. Internal to the company could be just a bad balance sheet. Bad balance sheets are to be avoided like the plague. You never know when the company hits a speed bump and doesn't make money, and you can't service the debt, and you blow up. You don't know. Bad management, stupid management, dishonest management, you have to worry about it. Self-serving management also. The third thing, often people don't think so hard about, is the business model. I would urge you to think very, very carefully about the business model, the business the company follows. There are certain business models that are absolutely not invested. It's a very blunt rule, but it's actually kept me out of trouble. And the objective of all of this is to keep out of trouble. An example of a business model that I quite dislike is a business model of a company that needs to go to the financial markets again and again and again. For example, it doesn't have to be a sort of small little company, it can be big companies too. Let me give you an example of a couple of big companies. One business area where a company companies have had to, over the years, go to capital markets, raise money, maintain a very good credit rating, which is a very risky thing, because credit rating agencies are human beings, right? The people at credit rating agencies get out of bed in the morning like you and I do. And on bad days, they say, oh my God, this is a bad company, this company can't make it. And then lower your credit rating. And then suddenly you are in a situation you cannot finance anything. You're in trouble. So businesses that need to go to capital markets again and again, or any form of external capital raising on a recurrent basis for their daily recurrent business, it's a very fragile model. People forget about this except in times of crisis. Example, big example. In fact, this happened the last time I was here in 2008. Bear Stearns. Suddenly Bear Stearns lost its credit rating. They were dead. Lehman Brothers lost their credit rating. They were dead. I mean, so that kind of model, if you are determined to avoid, I mean, the stock is actually kind of cheap on a sort of numerical basis. If you, however, look beyond the cheapness, the sort of very fragile concept of cheapness, you had a situation which was really something which was operationally very fragile, very dependent upon the capital markets. Absent the capital markets functioning, delivering the capital to you, you had to close your doors. And these two companies did. Now, it's not always that, well, not all companies that do this fail. Goldman Sachs did it. Morgan Stanley did it, does it. They're still around, they're still very much in business. So it's a very blunt instrument, like everything else. It is certainly something that has kept me out of trouble over the years. So that's one example of business models that are not robust enough to sustain in bad times. So those are some three sort of generic internal factors: bad balance sheets, bad management, not so less than robust business models. Let's talk about external factors. Now, companies obviously operate in business areas where they're buffeted by things external to companies. Government regulations. I mean, some businesses historically, depending on the country, are sensitive to regulation. How sensitive companies are to government regulation depends on the industry and depends upon the country. There are some countries you probably don't want to buy pharmaceutical companies. There are some countries you want to buy pharmaceutical companies. It all varies. This is very, very sort of a one-by-one kind of analysis that one has to do. Or, for example, another thing that one thinks about, which I think is very interesting, and people, again, don't really don't give it as much weight as they should, is looking at industry structures. Now, I will not talk about the modes, because I promise I'm not going to sit through that modes, but there is a kind of industry structure I avoid. And it's sort of converse. It's about like a no-mode industry. Okay, I mean, I don't look for modes, but I avoid industries where there are no sustainable sort of, I shouldn't say, at least even temporary obstacles to entry. We'll talk about a couple of such companies in a couple of minutes. But for example, when I buy things are cheap. Bad things have happened to the industry. Stocks are down, results are down. And with the passage of time, one of the things that happens is the situation starts to mend itself. Sometimes there's too many competitors. Well, that situation typically resolves itself in one of various ways. One of them is some competitors go out of business. Another is you have mergers, so you have fewer players, so capacity is in fewer hands that control. Now, the reason for worrying about this is, so I go through a long period where I own something, I make no money. I would like to, for at least some time, when things start to get better, when the clouds start to clear, I have a period of sunshine that I can enjoy. Which is to say, I want industry with certain kinds of characteristics that, for a period of time, that you don't have lots of new entrants coming and destroying the margin of the business. So whereas I don't look for large, long-term advantages, I certainly do worry about businesses that can be replicated. I don't want businesses that can be replicated, people that come in and just wreck my margins. I don't want that. What I'm looking for are businesses where you have, at least for a period of time, that the company can actually build value rapidly. And usually, typically when we buy these businesses, they're depressed. Losses. There may be losses, there may be headaches, there may be troubles. So these companies usually have some kind of tax loss carryforwards, which is a very useful thing. Because when times turn better, if there are obstacles to entry, they make money, and this money is protected taxation. So value for me, the shareholder, builds up more value. So that's the sort of stuff we try to do. We think about business and financial risk. We try to avoid things that are going to hurt the business, make it less attractive, or just permanently wreck your portfolio returns. I mean, it can happen in many, many ways, as I mentioned, internal and external ways. Embrace market risk is a slightly different thing, sometimes counterintuitive to people. Market risk is to be appreciated. It's a fact of life. You want to buy a stock, you've got to live in the stock with up and down. How do you coexist with it? Well, you can close your eyes and ignore it, which is not a good thing. But a better thing to do is, sometimes you are handed an opportunity, a golden opportunity. Somehow, sometimes the stock crashes, unreasonably, trades down a lot, it's your time to buy. Assuming you've done your homework and nothing, it's ceteris paribus, nothing else has changed, the something is very cheap, it gets a lot cheaper, buy. It's very simple. People tend not to do that. People tend to look at falling stock prices and freak out. That's what happens, unfortunately. Even professional managers totally do that. On the other hand, sometimes things go crazy in the other direction. And that's a different kind of volatility. The euphemism is upside volatility. And obviously, sometimes things get ridiculously overvalued. Leave. Just leave the party and leave the next person, next owner. Pass the package on and move on. Two small other things which I think should be obvious from everything else I've said so far. Because of macromyopia, because you're not forecasting the future, you are not forecasting earnings. I don't forecast earnings. You're cognizant of what earnings sort of are, look like. You don't ignore earnings, because after all, if it's a business, the business has to make earnings to pay people, to pay its interest, to engage in capital expenditure. But earnings are not the center point of the earnings statement is not the statement which is paramount in my considerations. The one that's really most important to me is the balance sheet. Partly because of macromyopia, a balance sheet is a terrific snapshot of the business here and now. It gives me a sense of what assets it has, what liabilities it has, what sort of oncoming liabilities it has in the footnotes. And if you do your business analysis, you know what other stuff is not on or off the balance sheet. So you have a terrific snapshot of the business here and now. So it allows you to do a number of things. One, valuation. You can use the balance sheet as a starting point for evaluation. Historically, I believe, I would like to say, and I've said that before, is that it is the most conservative way to do it, assuming you do it right. Second, it also is a guide to the risk avoidance, because everything else being equal, a company with less debt is more attractive, less risky than the same company with more debt. Secondly, a company which has the balance sheet provides you the lists of assets, the kinds of assets it has. The assets have different degrees of liquidity. Obviously, cash is the most liquid asset. Working capital is slightly less liquid. Fixed assets, depending on the nature of fixed assets, are a bit less liquid. So it gives you a sense of the liquidity. And suppose something went wrong, what could you sell to make sure that the company goes forward? So it also is a source of assessing the level of risk or risk avoidance. So balance sheets to me have always been a very, very important. If something went bad, this was the safety deposit box you could pull stuff out. Not, again, you think in terms of bad things happening, how do you mitigate, how do you minimize, how do you cushion the bad things happening. So hence the thing about balance sheets. And finally, invest for the long term. Now people always ask me what's the long term. Ideally, I prefer to invest 3 to 5 years, preferably a lot more. Not because I'm lazy, but I suppose, the ideal is to have something and buy something very, very cheaply. Typically, when you buy something very, very cheaply, something has happened to make it cheap. That's what we're going to talk about in the next slide. When things have happened to the company, or the industry, the business, or the geography, or capital markets, to make something very cheap, it takes time for it to be resolved. The timing for it to be resolved can vary from business to business, and industry to industry, and country to country. And so, you have to be patient. Patience is a very, very important thing. And so we start out with the assumption you're going to own this investment for a number of years, be 3, 4, 5, even more years, hopefully. And if you do it right, and you buy it right, and I've always argued the money is made when you buy something, not when you sell it. Buying something correctly is the source of profits, not selling something. Selling is, I won't say inconsequential, but is relatively speaking a secondary consideration. And you will, when you buy something, if you invest for the long term, what you are not doing is you are ignoring catalysts, short-term catalysts in your investments, and what you're doing really is you're really going for one variable, the cheapness, and obviously survivability. Yep. And so typically what I've found is that the cheapness of an investment will act as a catalyst in itself. So these are 5 basic characteristics. I've talked a lot about them. The reason why I talk a lot about them is they are sort of the springboard to the next bunch of things I want to talk about. So that's 1, macro myopia, judge a business on its own. It's totally bottom up investing. 2, buy cheap and very cheap. And then by which I mean our valuations, the valuations done this way, are way cheaper than most people's valuations of businesses. 3, avoid business and financial risk, but emphatically embrace market risk. 3rd, balance sheets will trump income statements, certainly in this approach. And finally, invest for the long term. Yeah. Success. So what does this mean? So if you run a portfolio, so when you go from individual stock by stock thinking to what about a whole portfolio? So what does this look like? Well, you buy stuff cheaply. You tell your clients, you take the money in, you invest the money for them, and you tell them you're going to buy cheap stocks. What do you do when there are no cheap stocks? There's nothing to do. I mean, it's as simple as that. Now, as logical as that might sound, sometimes it is difficult for people to do that. Again, it depends upon the nature of the portfolio, what is investing and running. It depends on the client mandate. However, an ideal portfolio, in my mind, has the ability to hold cash. Cash is what connects yesterday's balance sheet to today's balance sheet to tomorrow's balance sheet. Cash is what allows you to take care of tackle opportunities when you can't sell anything else. The argument is always made that always run your portfolio fully invested. If something else comes up that's better, sell something and buy something else. That's easy to say. That's easy to say. Life is, I mean, in a perfect world, the world is far from perfect. In that, there may be days there just isn't a decent bid for your stock. So, cash is a very useful thing. Cash is highly underrated asset in many, many cases. And usually, the pressure from clients and people have no cash is at the worst times. Why? Because the stock market is going up, stocks are going up. Why are you in cash when returns are being reduced? What people are ignoring is today is always fallback, tomorrow you have big savings today. So cash is a residual of the investment activity. You invest until you can responsibly, reasonably, prudently invest. The rest, you hold off. Maybe tomorrow will be a better day for investments. The second thing is this investment style. What does this say about portfolio concentration? You spend a lot of time thinking about companies, businesses, sorting through them, and so forth. It does not lend itself to portfolios of 100, 200 stocks that we turn over. You already mentioned that we tend to buy things at earnings for long periods of time. This style of investing best works in relatively concentrated portfolios. Again, I mean, it's a very labor-intensive style of investing. So on each investment, lots of time is expended because of lots of competitive analysis. Where does this company fit in? Why do you own it? And so on and so forth. What sorts of adverse outcomes can happen and so forth. So ultimately, it's a very labor-intensive style on a stock-by-stock basis. So it typically lends itself to a somewhat more concentrated portfolio. Over the years, I mean, look, there's been people who've been wonderful in this business who run 100, 200 million stock portfolios. Good. My comfort level has been with 30 to 50 stocks, and some portfolios much smaller. Assets versus earnings. So I mentioned that we are very focused on the balance sheet as opposed to the income statement. What does that do to the portfolio? Well, there is clearly a bias in this style of investing to businesses that have assets. Assets which, I mean, they don't have any brick and mortar kind of assets, but they have the assets such that there is, at some point, a value to them, a marketability to them, and in that sense, there is a tilt. So you're probably not going to see businesses that have just people, purely people, and have no physical assets. Which is sort of a shame, I suppose, because there's a lot of people-focused industries that are extremely high return capital industry. In our way of thinking, it has historically been, people do take the elevator, getting out of the building every day. They may not return. Something happens. So there is, it's some tension between asset-light and asset-intensive businesses. This investment style does tilt towards asset-intensive businesses. That said, we have, over the years, invested in service businesses, be it securities brokerage, be it advertising industries, and so forth, which in situations which are asset-rich, there have been options. Though stock price volatility can be such that you can sometimes get businesses, like advertising agencies, below their net current assets. It happens. In case of emerging versus developed markets, and this is actually particularly interesting. Okay. So, years ago, about almost 18 years ago, when I started my first fund, and I was going to approach investing in emerging markets in this manner, I was told by a number of people, you can't do it in emerging markets. Emerging markets don't work that way. You can't, everybody, you'll never find anything to do. Well, I wrote an essay which talked about the sort of coming future of value investing in emerging markets. That was written in 1996. So it's always very interesting to read what you wrote in 1996, what you thought was sensible, and reread it with the benefit of hindsight. Now, the reason why people said it wouldn't work is the following. And because this style of investing, as I mentioned, is very focused on assets. It works if you have very low valuations in relation to net tangible assets of a business. The problem is, people invest in emerging markets, and the big argument of investing in emerging markets, most of the time, is that there's going to be growth. The developed world is slowing down on a permanent basis, getting older, demographics are terrible, and the emerging markets are where the action is, earnings are going to grow, and so forth. So emerging markets de facto have become a sort of scene for growth investing. Growth investing typically is very earnings-centric in its focus. People think there's earnings and earnings growth as a basis of valuation. And, of course, there's always a requisite level of optimism required to invest in emerging markets. So valuations never cooperate, but were not believed to cooperate. So that fund started in 1996. And looked at India, there was nothing to do in India. But we looked at Pakistan, there was a lot to do in Pakistan. Then we looked at Sri Lanka, there was a lot to do in Sri Lanka. So didn't have anything investments in India, but had a bunch of stuff to do in Pakistan and Sri Lanka. I'll give you a flavor of the kind of stuff we did in Pakistan, for example. So, visualize this for a second. I'll give you two examples. One was a company which was a brokerage firm. The brokerage firm, in those days, this is down, we go back to 1996, could hold assets in US dollars. I mean, nobody really, most people, the thing about emerging markets was really interesting is people tend to flock to certain kinds of companies. People flock to all the big names, and so you always have the big names at a certain valuation, which is ridiculous, and then you have a whole bunch of other stuff. There are more, and there are less financial industries for most emerging markets investors. People work for consumer products companies and all that kind of stuff. All the stuff that's a big demographic boom is going to send higher and higher. So first company was a brokerage firm. Now the attraction here was very, very, you'd have to be approximately and this is in the late 90s, 96 to be precise. And what was interesting was the market cap, equity market capitalization, he had no debt. He didn't believe in debt. It had a market capitalization which was less than the value of his US dollar holdings on his balance sheet. That's a starting point. The guy was making money. He had 3 seats in the Karachi Stock Exchange. Maybe something, but he was still cash. And you sort of go on like that. It was really 3 times a to some route or something like that. And historically, it was a person we knew over the years, having looked at them, having dealt with them, is reasonable integrity. It's a business which can be a wildly woolly business, but so that was one investment. So I thought that was a good deal. It was a very good deal. So that was one investment. I'll tell you what number two. Second investment we made. Again, forgive me. I mean, these are two investments we made, and it may sound like bias, but we made them in those days when you could actually get really interesting investments, because as I said, Pakistan was off the radar for a number of people, as was Sri Lanka. Then we had the second business there, which was an insurance company. Insurance companies in developing markets are very interesting companies we can talk about later, but it was particularly interesting. It was in Pakistan as well, less than insurance companies, many of which are not investable, as it did in those days. Many brokers hadn't even heard about this. I just got all the financials of all the insurance companies and went through all. And this one stood out as being very unusual. Why was it unusual? So, insurance companies make money in two ways. The first principal way you should make money is when you get money for when you write insurance policy, hopefully you take in $1, you pay out less than $1. That's called making money on your insurance underwriting. Yeah. Some people don't always do it. Some people persistently pay out more than they take in, but they take it in and hope they can make money in investments. That's a bad business. But these guys were very good at what they did. They had about 20 clients, largely multinationals. They worked only for businesses, sort of a commercial underwriter. They reinsured most of the stuff out of Munich, which was good counterparty, then and now. And what they did, the profit margin on this underwriting sustained over the years. I mean, usually 3 to 5 years, just to get a sense of how they run their business, is they made had 40% margin. So basically, they had a 60% combined ratio, which is impressive, which is really impressive. Now, if you think that was good, it gets even better. So, when you make money on your underwriting and insurance, you invest the money somewhere. Now, fixed income securities and Islamic finance it's just like a convoluted thing, but there are things like that. But what did they do? What did they do with this money? It went into a couple of places. They, while waiting for investment opportunity, they parked it in these interests, fixed income devices. However, periodically they buy a lot of stuff when it got cheap. So what did they own? And this is where it starts to get wonderful. So the single largest holding was a company then called Lever Brothers Pakistan, most recently called Unilever Pakistan. In fact, it's been taken over. Now, visualize this. In those days, Hindustan Lever was at 50 to 55 times earnings. Some unnatural number. This thing was at 7 times earnings. So much was this disparity. Now, the business mix was slightly different, of course. That business was, they had a lot of very large exposure to tea, there was tea smuggling, all kinds of stuff like that. But look, you talk about 7 times earnings for a company that had a 50% return on equity. I mean, not that I look at return on equity as a basis of buying something. This is like, whoa, this is awesome. Because they were the second largest holder of Lever Brothers Pakistan, outside of the parent company, Union. The second largest holding they had was a subsidiary of Nestle's called Nestle Milkpack. Now, Nestle Milkpack, they were the second largest holder of it, like they had the other case, and again, this was a very cheap investment, and it was a great company. It was doing very well. The third company they had was a company called Packages. Packages was a business that made packaging material for all kinds of consumer products. This be biscuits, be it in foodstuffs. So as the foodstuffs industry grew, packaged foods industry grew, they would grow as well, and it was also very profitable. So we had one more business, and I will stop there. This description will tell you why it was interesting. A company called Treat. Treat is probably a totally unknown business here because it exists over there. The name anyway. The business was razor blades. Treat was a business that was much more profitable, had bigger market share than Gillette in Pakistan. So now you know who this is reminding you of, right? I bet you could think of Warren Buffett or somebody like that. But so this stock, interesting enough, again, this is 97, was trading at less than the market value of the Coley and Lever Brothers pasta. So everything else is nothing. So I bought it, I put it away and said, we will see what happens with this thing. So I sold those shares that I bought just recently when we rounded our funds and we made, I don't know, probably about 18 something times the money we put into it. I mean, I forget the dividends. This is just the capital. The other investment was we held from 96, 97 to 2008, the brokerage company. Now, my approach to all of this has been very simple. These are very small investments. You couldn't buy a lot of them because the insiders wanted more and more and more. They come and approach you and buy your shares. I said, no, give me a better price. I'm thinking about it. I'm not selling my shares to you. I mean, needless to say, when time came to sell the shares of the insurance company, done. One trade out. On the other hand, it took days and days and days to accumulate your shares in those shares. So the brokerage firm is slightly different. The brokerage firm had dollars, and of course, in those days, everybody was running for Pakistan. And they bought Citigroup's investment banking business, which was a listed company, net current assets, and they grew that business. So it became from a brokerage firm, there was an investment banking business, an asset management business, and an insurance business. So it became a much larger financial kind of entity. And it grew year after year. And it never really looked expensive. And so we just let it sit and linger in the portfolio. And so that was initially purchased in 1997, and we sold it in 2008. Now, what caused me to sell this? Well, what caused me to sell this was, it was pointed out to me in probably March of 2008. The stock had gone up tenfold in the 3 months. And I said, the business is growing, but not that much. That's a lot of growth to be embodied in the stock price. So we sold it. It made no sense. The valuation made no sense to me. Sometimes you do that. The valuation makes sense, you get rid of it. And what turned out to be the case, so the post-mortem on the stock was as follows. I don't remember the dividends anyway. That's actually calculable. But we bought, our average cost there was 11 cents per share. Our sale price was, again, 11 years later, was $13 per share. So patience means something, and certainly if you buy right, it makes a lot of sense to do it. But you've got to be patient. You've got to be able to give it all the craziness that goes on in emerging markets. Pakistan, you may remember, in 1998, shortly after I bought stocks, there was a device that was exploded here, the exploded device. And then, of course, the market was closed. Then, of course, the currency was frozen. It was just, you have plans to do. It's important. So, just to give you a sense of, it's not a smooth ride. There is certainly payoff for the pain that's involved sometimes. But it works very well in emerging markets. Okay, you just have to adapt. Quickly, one more. Resource conversions as a source of return. So what you try to do is buy businesses cheaply in relation to what they're worth to a private investor, an owner, business owner. What would you, so if you've done your homework correctly, maybe there's somebody out there who wants to buy the business from you. So it's the sort of thing where you buy a business way cheaper than it's worth, and replicate, reproduce, and so forth. Example, some years ago, there was a big TMT boom, a huge boom happened. So one of the things that intrigued me, and has still intrigued me, is all this fiber optic capacity. Fiber optic capacity is horrifically expensive. Horrifically expensive to get to the ground. Now, a lot of people put the fiber optic capacity on the list. They borrowed a lot of money because the future was going to be rosy, and most of them went bust, and of course, there was a lot of capacity that happened. So the idea was, if you buy up this thing at a fraction of what it's worth, maybe somebody's going to take care of you and buy it up from you. And that's exactly what's begun to happen. So over the years, we bought as many fiber optic kinds of companies with lots of capacity, but in interesting places. And one by one, you start to see them disappear. So that's called the resource conversion. Now, resource conversions doesn't mean just takeovers. It means when there's a non-operating source of return. More generically, for example, a company sells an asset with the excess cash, pays out the excess cash. That's a resource conversion. Mergers and acquisition transactions, those are another example of resource conversion. So if you have done your job correctly as an investor, doing this sort of stuff, the odds are you will have one or more of the companies over time taken up. Now, it is not a dependable source of returns, in that M&A activity happens and it doesn't happen. This is a very cyclical kind of thing. Currently, certainly there's a lot that's happening. And for example, in 2006, which is a very, very big year for this sort of stuff, roughly a third of the portfolio disappeared in M&A transactions. So very good transaction, great stuff, but the problem is finding good stuff to replace it with. So it's a two-edged sword also. Obviously, it's a good company that will grow and develop in the future. Oh yes, and good assets need that. This is sort of important. It's very important for this kind of investment because look, you have a box here. It's good, $10 in it, and you're trying to get your hands on it for $5. Somebody else is going to try to get the whole box, not have a part of the box. So, asset-rich companies attract crooks. So, watch it. I mean, seriously. That's an important thing. I mean, there's often happy endings, but sometimes there's some not so nice people who try to get control of the assets and use them for their own purposes. Strip them out of the company into their companies. So it's very tricky because if you buy a company which is controlled by another company, related party transactions can be used to extract the cash from there. There's a lot of stuff there, but that's very important. And sale of securities. So, when do you sell this? Well, this is hard. As much as buying, you can work very hard at buying, and I emphasize that there's a disproportionate amount of energy that goes into thinking about what price to buy, do the analysis of valuation. If you notice, our approach to buying is it's not symmetric in that you discount as many things as possible. You're absurdly conservative and you value a business. Now, when you sell it, you want to sell it to somebody who's wildly optimistic. Not like. So in my methodology for buying stuff, does not work on the other side for selling stuff. So the way I've dealt with it over the years, I mean, one very facile characterization is buy on assets, sell on earnings. So, companies recover, businesses recover. Things which had no earnings, had losses and all that stuff, suddenly at some point start to make money. Earnings happen and people expect bigger earnings. And some days people say, you've got to have this. You've got to have this. And I'm there. Please take it from me. So that's really, it's much more a judgment. It's a softer judgment. And so, that's sort of how that works usually. Sometimes securities companies are taken over and they disappear from the portfolio. Those are some happy endings. There's some bad endings also. Not everything works out. We have some poor investors. For example, you make an assumption about a company doing certain things. You have expectations. A company that's in business A suddenly decides it's going to use its balance sheet strength and go into business B. Is this what you really wanted? And are you happy with that? If the company does when you bet the company kind of investments, you need to think about it. If a company zigs when you think it's going to zag, it's probably worth reconsidering the investment. Or if it's doing anything to compromise its financial ability, you should absolutely worry about it. So anything that's going to damage the company's viability long term has to be a basis of thinking about selling something. Let me then talk very briefly about this. I suspect we're not going to make it through the whole thing at this rate, but so we'll probably half of it, so I'll get about that next time. So where do these ideas come from? Now, we've talked in generalities. We've talked about a number of these things, and again, what I've historically done is cover the world. We've covered the world with a group of people, less than half a dozen people in the US. 4 or 5 people in New York. For a brief period, we had a couple people in the city. So how do you deal with it? So, first and foremost, if we look back to what we're trying to do, we're trying to buy something very cheap. If you're trying to buy something very cheaply, something should have happened to get it there. There's some reason why it's cheap. Maybe something's happened to the company, something's happened to the industry, maybe something's happened to the country. Maybe you have a big capital markets event, by which I mean something akin to a larger thing like the global financial crisis or the Eurozone crisis more recently. If you think back a decade earlier, you had a big Asian crisis. That makes a lot of things very, very cheap. So those are those kinds of things. Sometimes opportunities happen if something is complex, analytically complex. People don't like to deal with things where they have to think too hard about these. I've found over the years, people like stuff easy. You have to have a story you can tell in less than 5 minutes, and people like that. If something's sort of in a complicated corporate structure, it's a very unusual kind of structure, people run away from it. Those historically have been very good to us, very, very good to us. Those, in fact, I mean, in markets with lots of disclosure, like Singapore, we've actually had wonderful experiences with those. Now, crises, I mean, this might suggest that we keep looking for crises. Well, where ideas come from is actually not that complicated. You read a lot, learn a lot. I mean, over time, you wind up having looked at lots of companies, lots of industries, lots of businesses, lots of geographies. You'll have an amazing amount of accumulated knowledge for you to react to opportunity if as and when it occurs. Really, this is preparedness meeting opportunity. There's accumulated learning meeting opportunity. That's what this is about. Sometimes, you might even anticipate opportunity. And I'll give you 2 quick examples. One is a country, the other is an industry. So, for a number of years, we look at Romania. Romania is a country, there are many communist countries went through this big transformation from a communist regime to a capitalist regime. And there were all sorts of headaches along the way. Some of them made it, some of them made it different ways. Romania sort of incompletely transformed itself. The thing with Romania was they talked about sort of more private sector, but a huge amount of government involvement. The government controlled large swaths of sectors like hydroelectric power, nuclear power, aluminum plants. All kinds of stuff was controlled by the government. All kinds of stuff. And the problem with excessive amounts of ownership like that, it results in many non-economic decisions, which results in running deficits, which results in ultimately it hits a wall. And so we started to see those walls coming. And so we wondered, how will this resolve itself? The problem with Romania was, there was not a whole lot of invested at the time. It was just nothing that was interesting. Nothing sizable, nothing interesting. So we waited, we watched, and Romania predicted to hit a wall. It hit a wall, and then the following thing happened. The IMF was called, as was expected, and the IMF had a very interesting prescription. So Romania, in its transformation from communist to a less communist country, had a fund, a company, which was the source of reparations. The communists had confiscated a lot of people's property. So to compensate people for the property that they'd taken away from them, they were going to give them stuff back. The stuff they were going to give back to these people was shares in a company called Fondul. Fondul Proprietatea, was actually on the over-the-counter market. It was not listed. But so what the IMF said was listed on the over-the-counter market. What Fondul had, this company had, it was a collection of different businesses that government controlled. Most of them completely or largely government controlled. And to raise money for the government's balance sheet, the IMF prescribed that all these companies, many of these companies, had to be privatized. Just to make sure that this process proceeded normally and sensibly, the management of Fondul was no longer to be done by the government, and the government had to have outside fund managers manage this company. Basically, this was like a closed-end fund. It was a collection of many different companies. It was holding a hydroelectric power company, nuclear power company, gas companies, a whole bunch of oil companies. So there's a whole bunch of companies sitting inside that, which were going to be privatized, and the money would come to the government, it would come to the fund. And there was a beauty contest held for who was going to manage this fund. The finalists were Morgan Stanley and Templeton. Well, Templeton won it at the end. It was then listed on moved up to the actual main Bucharest Stock Exchange, and it's the largest capitalization company. It's number of billions of dollars. And so the first thing, of course, the company did was install directors of all these companies and begin the process of pushing forward. So this thing suddenly became a very interesting investment. It was when we started at least 60% plus discount in the asset value at that time. And so that was one where anticipation of crisis led you to look. A second example, I'll give you very briefly. You could read about it. We actually talked about it. I wrote about it in one of the letters for that when I was at Third Avenue. The telecom industry growth. For many years, the telecom industry, mobile telephony in general, has been, Europeans have tended to look down on Americans as too backward, which is historically been true. They had 3G, and they had this thing more of a 2G. In any event, fast forward. So, what happened to that miracle? Europe proceeded to regulate the living daylights out of this industry. First, you had each country had its own telecom regulator. Then on top of that, you had a European regulator. And then on top of that, you had a antitrust. So, it is a business which is very capital intensive. It is a business with tremendous scale economies. So if you're going to mandate at least 4 telecom companies in Austria, which is not got a huge population base, each company unto itself is not going to be able to exploit any economies of scale. And what's more, what was also a bit unusual about this regulatory regime was because Europe believes that they are one big happy family, they think that there should be no roaming charges when you go from Austria to Greece, or Sweden to Spain, stuff like that. So every year they're pushing down the roaming charges, mobile termination rates. It was absolutely astonishing. So as a result of that, companies didn't have much money to reinvest in the business. They made less and less money, and they had very little money to reinvest in the business, and many of them are way behind on the 4G rollout. Whereas the US, you really have 3 basic companies, which have a 300 to 300 million population base to cover, and you have serious economies of scale. So that idea never really caught on, and so a number of the European companies took on a slightly different strategy. They said, look, there is no growth in Europe. We will go to emerging markets now. In theory, yes, that can also backfire very badly. You're not making much money in your basic business. Your basic business requires you to reinvest. You go to emerging markets also require you to invest quite a bit because they're growing very rapidly. And the governments are pushing you to invest. So most of these companies, especially the companies on the Mediterranean, be it Telecom Portugal, be it Telecom Italia, and Telefonica, have very sizable operations in Latin America, a good chunk which have been funded with debt. So it all came to a bit of a end last year. We looked at this industry with some curiosity because it just made no sense. It really made no sense. I said, when is this thing going to hit a wall? Kind of like Romania. And the clue was Italy. The clue was Italy because Telecom Italia itself is highly leveraged. Telecom Italia is controlled by 4 parties, 3 of which are financial institutions in Italy, and the 4th one is Telefonica. So 3 of them are systemically important financial institutions. They control that with a whole bunch of debt. Telecom Italia was about to hit a wall. There would be a series of debt downgrades up the chain. So the financial institutions would also suffer downgrades. And of course, as a result, you'd wind up with what Neelie Kroes, the telecom regulator, said, we're about to have a Lehman moment in Europe, which I thought was interesting because it would have been a serious financial crisis. I mean, if you started the largest institution, the largest insurance company, the second, third largest bank, and would blow up, get downgraded, you'd have some serious trouble. So the whole regulatory regime has begun to change a bit. And that anticipation of this crisis led us to a huge opportunity. Again, the risk that was governments continue to use things. So, okay, I will not belabor this. We can talk other examples later if we ever have time. But let me move on to something completely different. This holding companies, and I'm going to be very brief. Or should we just stop and do some questions? 20 minutes. 20 minutes. Well,
maybe we can do about 5-7 minutes and then
okay, 5 seconds. So why holding companies? Well, holding companies are interesting for a couple of reasons. One, they are, first, what do we mean by holding companies? Holding companies is an entity which owns, controls, wholly or partially, a bunch of different businesses. Businesses, listed businesses, unlisted businesses, public businesses, private businesses. Okay, so it's usually, you can think of it as a conglomerate, you can think of it as basically an investment company in everything in it. Now, why are holding companies interesting? Let me just quote something to you, and I will confess, before all this, I was unaware. I had written an essay on holding companies some time ago, in 2012. The Economist, in the June 11, 2014 issue, said this. It's the Shumpita Holding. I'll quote it for you. In India, conglomerates constitute 90% of the top 50 companies, in brackets excluding state firms, and had an average revenue growth of 23% per year. End of quotations. Now, of course, what is 23% in 3 years, 5 years, 10 years, I don't know, but that's what they said. Well, 90% of the 50 top companies is a lot of capital tied up, especially exclude public companies. And why they're of interest to me, have been of interest to me over the years, is, well, they don't fit most traditional models of investors. Most people like to buy, or seem to want to buy, businesses that generate earnings, recurrent earnings, and so forth, which are usually operating companies. Holding companies may have operations, may just have holdings, if they have land. No, earnings can't be land. Something, not much. They typically, if they have earnings, they tend to be erratic, they tend to be lumpy, somebody sells something, earnings happen. And so it's a very uneven kind of increase in shareholder value. So the question is, how do you invest how do you think about investing in something like that? They typically do not really lend themselves very well to conventional tools of investment analysis. Now, holding companies often have complex organizational structures because they're creatures which are used to control other companies. So you could have multiple different companies controlling each other. And by the way, holding companies are not just an emerging market phenomenon. Okay. Importantly, the argument has been made, holding companies exist in emerging markets because of shallow capital markets. What does that mean? It means that if you run a business which is a highly successful business and you generate excess cash and you want to start a new business, you will, rather than go to the capital markets to raise equity capital, you will use your internal capital to invest in that business. So what used to be one business becomes a two-business company, and so on and so forth. Okay, so that is historically been the argument why holding companies are in emerging markets. Problem with that reasoning is the following. The problem is that emerging markets have become less and less and less shallow. The capital markets are much less shallow here. So why do they continue to flourish? And in fact, why do they do very well? And I'll refer you to the article. The article is actually a good article. It's available. It's totally available in Economist. You should be able to get hold of it. These companies are not just found in emerging markets. There's a very famous one in the United States. It's called Berkshire Hathaway. Less famous one, no less illustrious. It's Leucadia, for those who fancy that sort of stuff. In France, you have a bunch of them. In Italy, in Belgium, Cologne. And then developing countries, you also have a whole bunch of them. You have a whole bunch of them. Now, where do these things come from? And the last thing is obvious thing because it doesn't fit any sort of paradigm. So, why do they exist? Well, they exist for a variety of reasons. Well, first, you have a disproportionate degree of control. It is often used there's usually a controlling party sitting at the top of it. And they usually use this as a means of controlling a number of companies underneath that. There's a bunch in India, the John Holdings is one, for example. There's a whole bunch of these companies here as well. Now, sometimes they're used as financing vehicles. For example, some holding companies in Hong Kong, for example, do their borrowing in Hong Kong, keep the cash outside Hong Kong, so they generate returns outside Hong Kong, and they use the interest tax reduction in Hong Kong. So there's lots of tax law. There's a variety of reasons that people can often do things like that. Now, the third item, I mentioned cash-shared legacy businesses. used to finance new disparate ventures. You know, sometimes the most improbable things happen. For example, the single largest bank in Pakistan, Muslim Commercial Bank, is controlled by Mishaq Mills, which is a textile company. Who would have thought that? I mean, it's quite astonishing. Or, for example, you have Siam Cement. It's a cement business which again controls a whole bunch of other businesses, paper companies and financial companies. There's a whole bunch of stuff underneath that. What you're doing is using cash flow of the core business, the legacy business, to finance the build-up of other businesses. So, this has historically been also true in the US. There was a period in the 1960s you had the conglomerates boom. I will not dwell on that other than to know that people saw these companies that manufactured things. So what happened in the conglomerates boom? You had a whole bunch of companies. And actually, it's true not just in the US, but New Zealand, many countries. What they did was they used to buy and sell earnings and manufacture earnings. Now, of course, you know, as I said, people like earnings. People want to be growing, rising, smoothly growing, rapidly. And there were a whole bunch of such conglomerates. There were the liquor industries as well, classic ones. Ling Temple worked in the US is another one. And what they did was they manufactured earnings. The problem is, manufacturing earnings requires you to buy and sell assets. And in fact, the most spectacular one of these manufactured earnings kind of holding companies was a New Zealand company. He was a very good investor, actually. But the problem was, Brierley, Sir Ron Brierley, and it was going to go Brierley Investments Limited, and of course, there was a time he, like Warren Buffett, could fill up a stadium with his annual meeting. And of course, over the years, he'd made his investors a lot of money. What did he do? He'd buy something and he'd sell something. And he'd do that over time. You report these earnings. And to do that, of course, you become bigger and you definitely need more. And you have to go bigger and bigger. You get bigger and bigger. All you do is buying and selling businesses, not having recurring cash flows, is you have to raise money. So, the problem is, at some point, the music stops. And the music did stop, and stopped in 1987, kind of a crash. Because people were trapped. No one would give them any more money. And because the holding systems collapsed, and there was nothing to sell at the profit. And of course, the whole thing went reverse. So, holding companies have a sort of very rich and colorful history. Some of it good, some of it bad. But so that is where analysis of a holding company requires why do people invest in what they do? The capital, famous capital allocation question. Okay? So, why is this of interest? If you look, so the thing about holding companies is the way people, I'm going to paraphrase this rapidly, if you look at the essay itself, but the way people think about holding companies is they calculate net asset value, then they look at the price. Is there a discount in net asset value? And then they end the analysis there. My argument is that's a pretty bad way of doing it. Most people do it, a lot of people do it, and that's sort of a bad way of doing it, because what you really are doing is you're buying two things. You are de facto making the decision that you want to own the companies inside. The companies inside the holding company themselves are attractive and they're cheap and desirable. And then you get this other layer on top, and you buy the whole package at a discount. And so that in a nutshell is this. That's what we see. So why is it magnified returns? The reason why I say magnified returns is the following. You buy something 30-40% discount. Usually when you have bigger discounts, typically reflect, again, it's a big statement or a new statement, some level of skepticism, dislike, or whatever by the market. It could be an industrial sector which is out of favor, and this in turn may well return to favor. So you've got two things happen. As the underlying thing appreciates and the discount diminishes, you get a double whammy. So you have a double discount. You're buying inside cheaply, and you're buying the package itself at a discount. So that's really what you're trying to do. Think of it as cheap leverage. It's like a margin account, again, because of insurance companies, even better, because here you cannot get a margin call. You just cannot get a margin call. Basically, it's like owning, $1 worth of assets for 40, 50, 60 cents. Depending, sometimes accidentally once, I wound up owning $1.20. Well, because I made the mistake, or at least made the assumption that something was worth zero, when ultimately it turned out not to be worth zero. So I was buying at 60% discount, not 80% discount. So that is sort of the reason why you want to buy these things. That is sort of core attraction here. Now, as I said before, discount is not the only thing. It's not just about the discount. It's about using the opportunity to buy something good at a discount. Something you want to buy, but buying it without a discount. So you can magnify your rate of return. So again, all these things, safety and avoidance of investment risk, same criteria as we said before. Next is, of course, these companies are controlled. Do you want to be embedded as controlling shareholder? Is this a person you want to engage with and be a long-term investor in? Minority shareholder abuse. It happens. It happens with regularity if you are in a controlled company generally, and especially these companies. Of course, if they're cheap, they recognize that they say the same cheapness as you, and they will try to gradually, use the cheapness to their benefit as opposed to yours. Now, what you ideally want is a owner management that is out there to make money proactively, and you as a shareholder will benefit. It is not using this merely as a vehicle to control their business. An example of two companies side by side, you think about it. Fiat is controlled by a holding company called Exxon, Fiat, the car company. Then there's a company, it's a French company that controls Peugeot. Two car companies, if you look back this a decade ago, two miserable car companies, both in sort of different degrees of trouble. One of them, of course, had, the founder died, his brother died, of course, there was new management who did all kinds of very clever things. They did clever things. They bought Chrysler in bankruptcy. They, in fact, merged Chrysler into a company. So it's a very, very different company. Peugeot is only slowly being disturbed. If you look at the rate of return of the two companies over the years, you will see an extraordinary difference. Maybe one company, both companies were run basically for control. In fact, Fiat was a hideous mess. It was two highly leveraged holding companies, owning in turn Fiat, which was itself a leveraged holding company. It was horrific. It was absolutely horrific. Now it's a wonderful. Peugeot, on the other hand, is not leveraged, never was leveraged, so it's less of a bad situation. So they were under less pressure to something. But the differences between the two are night and day, how they have done. Peugeot is now sterling. It's not horrible. So this is very, very important. Assessing management, assessing owners is a very, very important exercise. And there's two paths we can go down. I can show you pretty charts, and I can stop, or I can stop here. Sure. So I gave this talk in March 2014 in South America about holding companies. I was in Colombia. Colombia, just 1 second background, is a country that's emerging from a long period of great difficulties. And so this is one of the biggest holding companies in Colombia, Grupo de Inversiones Suramericana. It's a financial holding company. They own insurance companies, they own a bank, they own cement companies, construction companies, food companies, they own a lot of stuff. In fact, this is a big part of the market. The reason this came into existence is because each of these companies, cement and food companies, were under hostile attack by somebody who would buy them. So they basically bought each other to protect themselves. Okay, so that's how this company came to existence, and everybody's got to own this stuff out there in Colombia. And so I put up this chart. I said, folks, look at these numbers here. The publicly listed companies this much, private listed companies, this is a highly summarized version of the stocks. Yeah? There's an 11% discount. And so I asked them, what would you do? What would you do with a stock like that? Now look, this is what you see, the pretty picture, and these are the numbers. And being Colombia is a country where it's come over the years, so it's cheap, you gotta buy it. It's 11% discount. Put up this chart. This is a Brazilian company, GP Investments. And Brazil is having a hard time with it. It's totally self-inflicted. Brazil has this sort of schizophrenic situation where are we going to be populist? Are we going to be capitalist or populist? What are we going to be? We've got to engage in massive redistribution, and we've got to somehow sick of the creation, which is not a good thing for long-term creation, wealth creation. And so you look at a chart like this, and I point out to them, so what do you think of this? And I showed them this chart. I showed them this. I said, it's a 45% discount. And people look at me, look at the chart of the companies plunging straight down over there. And the other one's going up, and the other one's, they're good businesses, they're well run and so forth, and recognized well run. What happened here? What happened in the case of this company is private equity. It's one of Brazil's largest running private equity firms. It's a very famous, people have gone through it. Some people who you may or may not know the name of, people, the guys who bought Interbrew, Interbrew bought them, they run Interbrew, they're now running Burger King. I mean, the same guys started here, and these are similar guys doing similar stuff in Brazil. The reason why this happened is they made a couple of very stupid investments. And also, the issue stopped way there in 2006-07 at 3 times net asset value. Whoever bought at 3 times net asset value should have their head examined. Basically, what that's saying is, you own a dollar in your hands is worth $3. You're so good. And that's a terrible way of investing. And obviously, if you do stupid things like that, you would, of course, get hurt. And people got hurt, so people haven't really forgiven them. Anyway, so fast forward, that's those kind of people. They have traded 45% discount to NAV. And it's very experienced management. They've done a lot of really interesting stuff over the years. Very, very interesting stuff over the years. It's permanent capital. And an interesting thing, very important thing is this company owns the private equity fund, the general partner, meaning the fees that you pay for this are equal to less than 50 basis points of assets. Because private equity funds, people charge a lot of money, a lot. And this is a very, very cheap way to get access to Brazilian private equity, which, if done well, can be a very good business. So, in a nutshell, so I put this up. Why? Because I showed these charts at the end of March 2014. And since then, Colombia's been doing okay. It's been generally fine. If the de-risking has largely continued. Brazil has had a terrible election, at least from the perspective of financial markets. A lot of people did vote the government back in power. And of course, Brazil should be getting hit for that. So what we did was we recast the charts of these companies in US dollars and put them in the same place. Again, it's too short a period to judge anything. Too short a period to judge anything. But this is the chart on top is that the Brazilian company, the chart below is that of Grupo Universidade Sul-Americana, which is the Colombian company. One in the country which is everything's going right, another in the country where everything's going wrong. Microsoft cheaply actually really does good stuff. Seriously. And I'm going to stop here right now. That's it. I'm sorry, I just did not. So, surely I haven't put everybody to sleep here. Someone's got something to ask me about, tell me about, or comment on. So,
thank you, Amit. Questions, please?
Difference between this style of investing and Warren Buffett's style of investing?
Warren Buffett's style of investing? So, Buffett is publicly known in a big way for his investing in businesses with defensible moats. Okay, that's what we do. What is less known about all the other stuff that goes on? Though, so there's the Gillettes, the Coles, the Wells Fargos, and so forth. What is less appreciated is this sort of other stuff that he's done. He did and does. So I'll give you a couple of quick examples. So one thing Buffett has, Berkshire Hathaway has, is a great balance sheet. Very great credit rating. So credit rating is very important in tough times. And you can, for example, with that kind of credit rating, I don't want to use the word rescue, but take over the management of a company that has a falling, imploding credit rating. Okay? Get it for nothing, and use your credit rating, and continue the business very successfully. So he has done that for the people of Leucadia a couple of times. The most recent one is Berkadia, which relates to homes. And here's the building that Fenova, another company that was blowing up, of course. He had the capital, he had the balance sheet, he had the sort of people power. So that kind of stuff. For example, a company that I was the analyst on in 2000, a company called White Mountain. I had put it down as a purchase, and Mr. Whitman bought it for Third Avenue funds. And what was interesting about White Mountain was they saw White Mountain is basically, think of it as a merchant banking insurance company or financial services company. They will, with the help of the balance sheet and financing, buy suffering, troubled companies, fix them, and sell them. They do something. Or they even startup businesses. The most recent thing that White Mountains did in terms of sale, which was, I was very impressed by it, was they had this e-insurance business, or e-insurance, which they sold, which years ago I said, well, no, they spent a lot of money, they found a better, even higher price. So White Mountain does not fit the generic bill of a deep note kind of investment. What White Mountain was proposing to do, the story is, the transaction was as follows. There was a British company called Commercial General Norwich Union, CGNU, which wanted to get out of its US business. The US business had a number of issues. CGNU's US business was big, White Mountain was small. So they needed money. The money came in the form of preferred shares, convertible preferred shares, which were bought by Warren Buffett, Prem Watts, Lucadia. We had already bought them, I'm sure that's already. So that was sort of our similarity in our investing. What else? Give you another example. We've been on the opposite side, Third Avenue's been on the opposite sides of the table. There was a housing, manufactured housing company. His name is Clayton House, thank you. Clayton House. So Third Avenue was a holder, Buffett was a buyer. We thought his price was not attractive. But he bought what it is. Again, Clayton Homes was suffering because the financing homes had dried up. Clayton Homes, since then, has been in the market trying to buy homes. One of my colleagues used to run, who was a manager recently of Third Avenue Valley Fund, used to own a company called Catco. Catco is a big player. Catco and Clayton have competed for assets over the years. So there are similarities, but there's a large visible investments into the sort of much more big moat kind of companies. But that said, if you look, for example, he is buying large cash consumer companies. Can be periodically cash consumer companies. The utilities, the railroads, for example, which can be periodically very large cash consumer companies. But there are similarities, certainly, very much so. Very much with the earlier Buffett than the later Buffett. The overlap's much greater there.
Many investors in a country like Pakistan or Bangladesh.
I didn't have to do
Okay,
Pakistan. Okay.
So the level of regulatory filing, so the information available is quite low as compared to when you invest in US or developed market. So
Most developing markets are like that. So you spend a lot of time learning about the business itself. See, there's a couple of things. The US is spoiled. You can't even judge US and developed markets generally. The US is, I don't want to say it's better, the US, the extent and degree of required filings is extraordinary. So the thing with that is both good and bad. It's good because lots of information becomes available. It's bad because it lulls investors into a false sense of security. Witness. Enron was a gigantic thing that happened in the United States. The stuff was there. People could have read it. I mean, I'll give you a personal Enron story. So, where's my place? So, you look at the 3 years of numbers, and a lot of stuff becomes very evident in the nature of the business. So you look at the way the business is being run. The business is making more money, but it's taking more and more capital to make that kind of money. The returns on the incremental capital are not very good. Why are they doing that? So the rational thing to do is, of course, if your existing business is making so much money existing capital and it's trading at cheap, try to stop that, assuming you can get it at a good price. It's So it already began to make no sense. And because the incremental capital that was being employed it was more and more and more leverage. It was like a gigantic hedge fund. Now, so look, I don't know. I mean, I don't know how they'll do. I mean, but they certainly are making less and less money than I think they should be making. So I'm not sure what's the big attraction here. I mean, do they have risk controls on the Goldman Sachs? I mean, even Goldman Sachs can slip up at some point. I mean, it's all comes from the human being. So everything else being equal, business analysis will guide you quite a bit. So why Pakistan? To your point about Pakistan. Like most countries, I mean, they're good companies, they're not such good companies. You spend a lot of time learning about the people who are involved in these companies. And you learn about that by getting to know people. And I suppose it's what's called a scuttlebutt factor. So it's very, very important. It's very important to learn about the kind of people you're co-investing with. I mean, this company, the GP, for example, I was in Brazil at the time to make my stupid investments in 2006. And they got more. I thought it was a stupid investment. I said, maybe they're very clever guys, but maybe they know something I don't know. So I went many years in 2006. Fast forward to 2012, and this has been quite interesting. And of course, the world still hadn't forgiven me for the stupid investment they made. Well, I mean, there's nothing to forgive. I mean, the people who make the investment in the first place in your stocks at a ridiculous price. I think they're the ones who are more responsible. You learn about them. You really do learn about people. So, to your point, it's totally true. There is less information. There's absolutely less information. That's mandated to be able to. But the businesses we typically invest in tend to be very simple businesses. Simple businesses where you can learn from other competitors, usually other players in the business, and so forth. You do a lot of learning, which is why it's a very labor-intensive process of deciding, learning about the business of the company and about doing it.
I have a question about the experience of position sizing. Right? Let's say, for example, I mean, you have you work on an idea where the business of a company is facing adversity, and you have done your homework and you are reasonably confident that over the next 5 to 7 years, the risk factors are going to be subsided and the clouds are going to become clear. So, do you go along and invest in the opportunity in the initial stage, or do you take your time and you say, okay, I will invest it over a period of time, maybe the returns will be lower, but the risk-reward ratio will be much better?
So, how do you think about investing when you get rich? It's like that. The demand curve slows down. Everything else will grow, the lower the price, the more interesting it is. It's not going to get through. I'm buying a shirt. Something simple. So, initially, my first piece that I will buy, because you're already a good size discount to the net asset value, so it's attractive enough to buy. That first piece, the first purchase, is the least price inelastic. It's so I have a bite. Now, then I will wait. Typically, not always, and again, typically, hopefully, I think hopefully is correct, not typically. If it was typically about the performance will be better. And so hopefully the price goes down. We wait, and we buy some more. And obviously with the passage of time, the other thing that happens is that your thesis, your theory about the company is either going to be sort of supported, corroborated by developments there, or not. I mean, you will have, again, you watch how the business unfolds. The focus is always going to be the business and the value that you get. The price you're paying, value, of course, is what you're going to get. And the idea is, hopefully, as you learn and you learn more, and it's supported with your basic thesis, you'll be able to probably add to it at that price. That's sort of, in terms of sizing, that's how position sizes are developed usually. This is not to say that we haven't built position straight down to this. Most things I buy go down. Most things I buy go down. My approach to investing is not an instant gratification business. In fact, it's mildly masochistic. So you have to do it carefully. You obviously have to do it carefully. Because To get those kind of that kind of pricing, things are bad. And bad does not automatically result in buoyant stock prices happy stuff.
At what price you stop yourself from buying more? Usually more attractive, or at what level of percentage allocation for your fund?
There's nothing predetermined. There's never any sort of a cap in the long positions, small positions. By and large, the position says, I'd like not to do something for less than 2.5%. I mean, ultimate 2.5%. Yep. Now,
We can take one more question.
Hello, sir. So you talked about recurring liabilities. I mean, three types of liabilities. One is the recurring liability.
correct.
So it's not something that a company would give you. That this is the kind of recurring liability.
Well, but that's why the company's not going to give you. I mean, which is why talking to companies is sometimes overrated. You have to learn about the business. You have to learn what's going to cost for the big machine. The big machine's worth a couple $100 million. So you learn. You put that into your plant. Then you learn from the ages of the equipment. You learn all this. It's not something that. See, people over the years have gotten very used to being spoon-fed information, which is so unfortunate because it eliminates the enterprising aspect. The opportunity is for one to go and do stuff on one's own. Which, by the way, just one very important fact, is emerging markets historically, because of the lack of analysts, lack of coverage, have provided some of the greatest opportunities for me over the years. So, for example, I mentioned we did lots in to go to India, we did Pakistan, Sri Lanka, in Latin America, people usually do Mexico and Brazil. Well, we did Mexico and Brazil most of the period. We, in fact, in Argentina, we did a lot in Colombia. A lot in Colombia, which there was nobody doing any work as an analyst. And there, for example, one biggest investment we made there was in a brewing company, a beer company. It was a monopoly brewer in Colombia, in Peru, in Ecuador, and 75% of the market in Canada. You had to do all the work yourself. We did about 80% of the work on the desktop in New York City. Then it was the company itself. But it's very useful to learn about business by yourself. Because look, there's lots of other industry benchmarks. You can use industry data to give you a sense of what reinvestment is needed in a brewery, for example. And so on and so forth.
I think one item that you might be familiar with is the idea of maintenance capex. We talked about that earlier. And I think that has some relevance to what Amit is saying. There are businesses which require you to keep pouring it in, and there are three ways actually that I've learned today. One, avoid those businesses. Two, deal with the way Amit does, to think of them as recurring liabilities and capitalize them and put them on the balance sheet, the visual balance sheet in his mind. Three, deduct it from the earnings statement, something that he doesn't want to look at, but we love looking at, is to deduct that from in your estimates of owner earnings, and then you calculate that. So either way, you should get similar answers. Okay, I think we'll have to end here, Amit. It's been I think quite an education experience for me at the minimum. I'm sure most of you have also learned many things, and I'm very happy that Amit came here. And let's give him a round of applause.